Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we are talking about what the term Series A even means anymore and what metrics really matter to investors with partner at Crosslink Capital, Phil Boyer. Given all the market craziness going on right now, it has been extremely confusing for investors and, more importantly, founders to truly understand what is required to reach the next round of financing. On today's show, we asked Phil to share his views on what founders should think about when raising a Series A round and what kind of recurring revenue numbers investors like to see, along with growth metrics, CAC to LTV ratios, and everything in between. We asked Phil about some of the different kinds of firms investing in the market these days and how they are changing the game for traditional Series A funds like Crosslink and what this means for founders looking for funding. Finally, we learned about how Phil and his team at Crosslink are approaching the market these days and what their LPs are telling them to do with all the capital they have sitting on the sidelines. But before we get started today, as our listeners probably know by now, the team at Ripple is always focused on helping our founders and CEOs find the best partners to work with. However, before we initiate any provider with intros to our companies, we always make sure to try the product first. And when it came to managing our fund expenses at Ripple, we were super excited when the team at Jeeves came knocking on our door. The team at Jeeves helped get me and my team set up with physical and virtual cards in days. I was able to allow my teammates to expense items in multiple currencies, allowing them to pay for anything, anywhere, at any time. We weren't asked for any personal guarantees or to pay any setup or annual fees either. Not only does Jeeves save us time, but they also give us up to 3% cash back on our purchases, including expenses like Google, Facebook, or AWS every month. The best part, Jeeves puts up the cash and you settle up once every 30 days, unlike some other corporate card companies that make you prepay every month. Jeeves offers a truly all-in-one expense management corporate card program for international startups, and we at Tank Talks could not be more excited to officially partner with them. Listeners of Tank Talks can get set up with a demo of Jeeves today and take advantage of our Tank Talks special with a $700 sign-up bonus and skip the wait list that already has thousands of companies waiting by visiting tryjeeves.com/Tank Talks to get set up today. Now let's get into this week's episode with Phil Boyer, partner at Crosslink Capital. Thanks for joining us in the tank today, Phil.
Yeah, thanks for having me. Good to see you, Matt.
You know, Phil, with all the craziness going on in the market right now, it's pretty confusing for investors and even founders to truly know what is required to reach that next round of financing. And before the pandemic, metric milestones were quite easy to figure out. But now with rounds going all over the place and valuations not really making sense, it's no rhyme or reason on where founders should really be aiming for. So Phil, I would love to kick things off by hearing how you have seen the metrics needed to raise subsequent financing rounds change during your time investing at Crosslink.
I've been investing in early stage for the past about 8 years now. So the market has definitely changed wildly over the last, especially over the last, call it 3 to 5 years. And really, actually, over the last 12 months, it's even gotten, even crazier. I think part of it, I think there's multiple flavors of each round, which is part of the confusion that often is out there, that I've heard from some founders. I mean, there's now multiple flavors of a seed round. There's, what people are calling a pre-seed round. It's more of a traditional seed round. There's even a seed plus, or people jokingly call it a mango seed, whatever you want to call it. So there's multiple flavors of seed rounds. There's also multiple flavors of Series A's, I think, that are happening. There's kind of the more traditional Series A, call it, you've kind of reached your early product market fit and you're raising $5 to $10 million, and then there's kind of a jumbo Series A that's happening especially for kind of second time founders or more experienced teams in very, very hot markets that are raising what used to look like Series B size rounds of $20 million or so at the Series A. So I think that's part of the change and the confusion in the market, is that there are multiple flavors of these different rounds. And, when a deal becomes particularly hot for whatever reason, they're kind of pulling forward a capital raise. So pulling forward a Series B into a Series A, or pulling forward a Series A into a seed round, that I think is kind of a different dynamic that's occurring. Part of it's there's been so much success on the liquidity side of things. When you look at just like the number of $10 billion plus IPOs, I think I saw in an article recently there's already been over 20 $10 billion plus IPOs this year, which is pretty crazy if you think about it. These are companies that probably have been around for less than 10 years that are $10 billion plus companies in the public markets. So you've seen that, and then there's And then there's a lot of acquisition, M&A happening in addition to that, and very large M&A outcomes, $1 billion or 500 to $1 billion acquisitions. So there's great liquidity, good returns happening, and then you're seeing investors of all shapes and sizes starting to move into different stages than they maybe used to play in. So later stage hedge fund kind of public market investors going into later stage, and then going into mid stage, and then even going into the earliest stages. So that causes a different dynamic there. And, like I said, being big outcomes at the other side of the gate, getting more aggressive earlier is kind of paying dividends. So that's happening. And then there's obviously new entrants into the seed market, a lot more institutional seed investors, pre-seed investors, seed, mango seed, whatever you want to call it, investors. So it's kind of a maturation of these different angles of the market that are happening and colliding all at once.
Yeah, it's crazy. I mean, we've become desensitized to these like 50, $100 million Series A rounds. It feels like the wait and see approach that venture firms typically took before all the craziness happened, where they'd be like, you know what, you don't have the metrics to get from, the Series A we like to see. We're just going to wait it out and see if you get to where we think you need to be. But then obviously the Tigers of the world come in and say, I'm not going to wait and see. I think I know that they're going to get there, or I have a feeling they are, and they just jump the starting line, right? So everyone's starting line is now being pushed upwards. As you've said, there's multiple, early stage rounds, and then the A's all the way to the D's are getting compressed into one growth round, basically. And you're just not really getting a fair start. But let's talk about how this works for the founders, because it's quite confusing for the founders out there. Because, yeah, all investors talk about all the craziness going on, but it's also kind of confusing for the founders, right? So, why don't we jump into it? As we all know, there are three main categories of companies to look at when talking about venture investing. You've got the SaaS, the B2B SaaS, you've got the B2C or direct to consumer models, and marketplaces. And let's ignore sort of the deep tech, the biotech, and the blockchain universe for now. And let's just focus on these three main verticals to understand what founders should look for in their own metrics when going out to raise a Series A round. So let's start with the basic enterprise SaaS metric. What are the minimum and maximum metrics needed to raise a good round? And let's start with the total ARR number. What are you seeing out there these days, Phil?
I'm happy to answer that question. I'd like to kind of zoom out for a second before we just jump right into there. I think it's important to note that actually regardless of what sector you are in, and there are different metrics across different sectors that matter for sure. I think there's like some foundational things that are actually even more important than your actual metrics at the Series A. Even everyone is pretty well established that seed, it's all about the team in the market, right? The investors looking at, is this a really unique and special team going after what can be a multi-billion-dollar market over time, even if there isn't a market yet, creating a new market, kind of aligning with the vision of the founders on what kind of business you can build over the long haul. So all about team and market and story and kind of vision, and that whole storytelling that goes along with that, the seed. I think at the Series A, and this has always been true. This isn't a new thing, I don't think, but it's still very much about the team in the market at the Series A. There are obviously expectations of growth in the business, and kind of early establishment again of the proof points against the hypothesis that was set at the seed round and at the genesis of the company, proving that that hypothesis might be true or looks like it could be true. But I still think so much of the when you're thinking about as a founder, preparing your Series A, just of course, be cognizant that the metrics are a part of that proving out the hypothesis of the product market fit. But at the end of the day, most Series A investors are still very much focused on, is this a really special team and a potential category defining team in a massive market opportunity. So I think that matters. That's kind of like the first order of business is when you're putting together that Series A deck, make sure that that is shining through, more than anything else, that you have a really special team. And this is why the market timing is right to go build this business. And this is why we're unique and going to carve out a multi-billion-dollar opportunity. And then the metrics, do matter. And I think it's really about proving that your like I said, your hypothesis is correct and you're on the right path. And so it's kind of early proof points against product market fit. that I think all the Series A investors are looking for. ARR, if you're a SaaS company, is kind of the top line metric that firms are basically measuring or benchmarking you against other opportunities they're looking at. That used to be, more traditionally, it was kind of $1 million to $2 million of ARR was, a typical kind of goalpost or milestone for a Series A company to go raise off of. That, given the dynamics that we just touched on, I think investors are certainly leaning in earlier than that, in a lot of cases, especially when, back to what I was saying, there's a really strong team. It's maybe a hot market. They'll go, as early as possible once they see some of those proof points against product market fit. So it could be, I would say, in terms of how the market shifted, there's a lot more Series A's happening pre $1 million of ARR. Maybe it's 500K to a million. I'm seeing a lot more deals get done, when companies are hitting those milestones. I've also seen earlier than that. I've seen Series A's with zero revenue, right? So, and it kind of is like, in those cases, oftentimes you're seeing second time founders, and it's often a really hot market that they're building their business within. And so it kind of skews things a little bit differently. But I would say, like, at a very meta level, that's kind of the in your brain. Most of the companies are kind of building towards that $1 million of ARR, as a goal to go raise their Series A, and then investors are kind of coming in earlier to preempt a round ahead of that. Is what we're seeing happening more often than not.
No, I appreciate you setting the groundwork for all of our listeners and founders out there. And I totally understand, that 1 million to $2 million number is still sort of the metric people should be aiming for. But what it sounds like you're saying is it's actually the growth that you have coming into the round that people are starting to aim more for. So if you're only at 250 or 500K of ARR, you haven't hit the million yet, but you've done, a 4, 5, 6X going into that number. That's actually what's getting people more excited about. So what kind of growth numbers do you think people should aim for going into that A raise to make sure that if they don't hit the million, they have the growth to back it up?
That's a great point, man. I think the momentum and the growth story is probably more important than the actual raw figures, and I think that's the case at Series A. It's also the case at Series B and Series C and beyond. Is kind of the really the it's that growth, because I think at the end of the day, back to what I was saying, at these early stage investing, you're betting on the team in the market. Now, on the team component, you have the evidence of execution, right? You can look at how long has the company been in existence, how long has the product been in the market, are customers clamoring for this product, is the team executing on product delivery, and figuring out, maneuvering their go-to-market model to figure out the right kind of veins within the market to really mine, to go sell product and build a big business. How quickly are they able to kind of execute on that experimentation, learn from the customer, follow the customer, and sell product. And so I think when you roll all that up, like, just the growth and the kind of the timeline to execution becomes so important. So I'd say growth rates. If you want to kind of boil it down to figures, I think in the early, and it really depends on how early you are. Like, in the very early days, you need a very high growth rate. So how quickly can you go from launching a product to getting to your first $1 million of ARR is going to give you a higher chance of raising that round. So if you're able to go from cold start, of launching a product to $1 million in ARR, within your first 12 months, I think that's a good barometer that you're at a high pace of execution. I think from there it tends to be, you know, okay, you're at a million ARR, sure, that's great, but really our goal is to go build $100 million plus ARR business. So, what kind of timeline are we looking at from here? And so that's kind of digging into sales pipeline, what you have ahead. Is there a path to a, call it, 3 to 5x kind of growth year into that next year? And so, any investor, when they're coming at the Series A, are going to be thinking about what are the milestones we want to hit before the Series B, and do we have enough cash and the right team in place to go execute on that plan? So, and the sales pipeline and everything else that goes with it. So it's really a forward-looking investment of, do we think there's a good path to go from one to, call it, between 3 and 5 million ARR in the next year, or at least within the next 18 months, so that we can go raise, a Series B at the, kind of those metrics and what happens at that stage.
Yeah, totally. I mean, I've spoken with some founders and tried to explain to them, look, this company went from 0 to a million in ARR run rate in 12 months, and they just raised it 100 million post money, and they raised 20 million or something. And then they're like, well, I'm doing 2 to 4 million of ARR, and it took me 3 years to get there. Why am I not valued at the same amount? And I was like, well, because you're still only growing 2-3% month over month, and so it's hard for them to swallow that.
Yeah, yeah. If you look at the bend of the curve, right? Because the history is the one thing. It's like, okay, or the point in time where you're investing, say it's a million or 5 million or 500,000, is one thing. But really, the investor's coming in for what can you produce, really over the next 5 to 10 years. And so, to get there, you're going to need to raise more capital probably to get to your next milestone. So, like, what kind of confidence do we have that you're going to execute over the next, call it 12 to 24 months with this capital that will, allow you to continue to attract capital, continue to hire, and get kind of best in class people on board to continue the mission.
Yeah, absolutely. Let's jump into some more of the tricky ones. Net dollar retention, which factors in churn and expansion by measuring the value of a cohort of customers over time, is something that people care about at the Series A level. Can you explain how founders should calculate this and what investors are looking for at this number?
Net dollar retention is essentially your, just to get the metrics, it's your churn. So your gross churn, which means your gross revenue churn, which means like how much revenue are you losing from your customers on either a monthly or quarterly or annual basis, plus your expansions. So your net dollar expansions, meaning your basically how much are you expanding your revenue relationships with your customers. And so the net revenue retention is your churn plus your expansions. And so that will give you your kind of percentage. So say if you have zero churn and zero expansions, you're going to have 100% net revenue retention. If you have 10% annual revenue churn, you're going to have 90% gross retention. And then say you have 20% of expansions, that means you're going to have 110% net revenue retention. So that's kind of the way to think about it. The reason why that's important is, it's really, and that figure, I would say, becomes more important, call it at your Series B round, and kind of beyond, because you have enough history at that point to really have kind of a full year of, at least one full year, probably a couple of years of customer relationships, and they can kind of see quantitatively how much your customers love the product. Because I mean, at the end of the day, actually at the Series A, we tend to talk to customers, before making an investment, and we're trying to, hear their emotion on the phone when we talk to them, and understand, like, is this a nice to have? Is this a must have? Are they absolutely not just going to keep this product, but expand the relationship with your company and product over time? And that's usually a good sign that you have established actual product market fit, not just an ability to sell a product, but that this product is a really important part of the puzzle for this company and something they want to really expand the relationship with. So that's something you do more qualitatively at the Series A. You're looking at, okay, you guys have been able to sell your product to these great customers, these great logos that are maybe forward-looking companies for the rest of the universe in that market. But like, how confident are we that this really is the right product for them and there's a big opportunity? Then at the Series B, C, and onward, you can really look at that much more quantitatively and understand how much revenue are you churning versus expanding. And so I think, like, best in class, if you look at kind of best in class companies that have been able to grow very organically with high net revenue retention, you're seeing kind of, call it 120, 130% net revenue retention, which means that without doing hardly anything on the sales front, you're expanding your your revenue base 20 to 30% per year just on your existing customers. And then you get you have a strong sales story and growth story that makes it a lot easier to grow, call it 3x year over year over the longer haul.
Yeah, I mean, we call it like the leaky bucket metric, right? So like, how much are you putting in the top and how much is actually falling at the bottom? And so what we tell founders is this is like a hidden metric that people should focus on more, because if you take, one step forward in getting a new sale, but you have two steps going backwards on what's churning at the other end, you really are no farther ahead than you were the month prior. And so this is a really important metric for us and something we think is a kind of a hidden gem for founders to focus on. And if they can show exactly what you said, that they can grow accounts without putting a lot of effort into it and not have anything come out the bottom end of the other side on the churn, then they have a much better chance of just growing more efficiently, right?
Yeah, I think it's one of those metrics that becomes one of the really core kind of lifebloods of the business, especially once you have established that product market fit and you're kind of off and running. It's got to be one of those on the top, three of your tracking charts in terms of it's not just about growth; it's about healthy growth, right? And I think net dollar retention really is a good signal that you are growing with the right accounts. You're selling to the right accounts, and your customers like your product. They're expanding your product. I think just to go full circle back to the Series A conversation. I think one thing I would say it's never too early to track these metrics because you know that eventually these are how future investors are going to start tracking your business and kind of valuing your company. So you really want to get in a good cadence of understanding these metrics and tracking towards success. But I also don't think you should be necessarily overcorrecting to some of these metrics very early on in your business because, for example, your first set of customers, you don't necessarily want to be customers that are going to, take your product down the wrong, road, right, the wrong direction. And sometimes it can be enticing as a really early stage company to say, okay, there's this massive, Fortune 100 company that wants to buy our product. They're gonna pay us $1 million a year for it, but then they may be, really just sucking all the resources of your team and product organization. So your NRR might look great with that customer, but it can really kill your business in your product platform you're building because you're trying to build something scalable at the early stage. So I just wanted to caveat that it is a very important metric, but companies at the very early stages shouldn't be overcorrecting to these things. Really, what they want to do is prove they're building something, yeah, a platform and a product that is scalable over time.
That's a really great point. I'm glad you brought that up because we've seen companies that, yeah, you're right. They have those big splashy logos and they represent more than 50% of their revenue, but they could be taking the product down the wrong path and they may not fit their ICP eventually when they want to go after that sort of larger market area. And they eventually have to fire those customers. And then that counts towards their NRR and their churn. And so that's a really good point, and I'm glad you brought that up. But let's keep it going and talk about some of the other metrics like LTV to CAC ratio, which measures the lifetime value of a customer divided by the business's cost of acquiring them. So firstly, what should go into calculating CAC for SaaS companies? Because a lot of founders argue about this and often get it wrong. And what should they be aiming for these days?
This is really going to really going to vary wildly depending on the business in terms of what is a good customer acquisition cost. But at the very fundamental level, it's tallying up your cost to acquire that customer, and that's sales and marketing spend, per customer. And then from an LTV standpoint, you're talking about lifetime value, and that's really should be based on a gross margin level. I think some mistakes I see on that metric is that it's just based on a revenue metric, but revenue can mean a lot of different things to a lot of different companies and products. And so, in order to calculate an accurate LTV, it should be based on your gross margin. And then it's net of churn. So it factors in your cost of goods and your churn to show what the value of a customer is over their life on average. It can be very hard to calculate LTV at the early stage. So I think we, at least at the Series A, I don't focus on LTV to CAC that much yet because I think you're talking about typically founder sales, to get you to that Series A level, and then LTV is going to be basically wrong no matter what because you're probably going to have the churn rate you have is based on such little data and historicals that it's just not going to be accurate. So, leaning too hard on oh, this company has a 5x, LTV to CAC ratio at the Series A, I think is kind of just it's a red herring, and it can probably be a distraction as opposed to focusing on kind of the fundamentals. But those become very important metrics to track, really starting or to focus on. I think really starting like Series B, Series C stage, where you've gone from just like early product market fit to showing that you have go to market fit, and that's where it's sales cycle for your deal size matters a lot, which will be impacted into that LTV to CAC ratio.
Oh, that's interesting. So talk about that for a sec, the deal velocity, sale to close ratio. What are you looking for in sort of that velocity at the Series A stage? Because that's really important to us as well. Those like one call closes are amazing.
This is kind of what I didn't finish my thought earlier on the like different products have different are going to have different CACs, and so I think that actually is a very important point. Is if you're a inside sales kind of organization that you're selling everything over the phone, and it's well everything's over the phone right now no matter what you're selling, but it's a maybe it's an inbound marketing model, so you're a company that's generating warm leads for customers. Maybe you're using a lot of paid marketing channels. Maybe you have referral partners that are generating warm leads. And then you're kind of closing those customers on a pretty short sales cycle over the phone. They either want the product or they don't. And those are probably lower deal size products because they sell faster. I think there's a different barometer on like what should be an okay sales cycle and what should be an okay customer acquisition cost. It really just depends on matching that cost with your kind of deal size and net revenue retention rate for that product. So like for example, if you have kind of call it 10, 20, 30K annual contract values or ACVs, you should probably have a faster sales cycle and a lower cost sales acquisition model. And so you're thinking about, can we sell this product in maybe 30 to 60 days? This is a product that can sell with some velocity, or at least less than 90 days, right? For that kind of ACV. If you're selling a product that commands a six-figure deal, like 100K, 200K, 300K, land ACV, you can get away with a longer sales cycle, and it still can make sense, right? So you can have something closer to 90 to 180 days sales cycle, especially if you have an expansion model on kind of 100 to 300K ACV that can go to a million over time. That can still be a very profitable deal for that organization. So I think just having a good sense for what are the sales economics to acquire your customer base. What is the sales cycle? Is it and then how does that match to the kind of deal sizes, and making sure that those sales economics are actually profitable. That's going to become very important, especially at the Series B, C, and beyond.
Yeah, that's a really good point. And some of our founders have really struggled between this sort of SMB mid-market sales, inside sales, those 2,500 to 3,000 monthly contracts, 30,000, 35,000 a year, versus trying to go after those bigger whales, those like $100,000, $200,000 contracts that take 6 to 12 months to close. And then they get to the Series A and they try to display, some of the either land and expand, and then people say, well, you're capping out at 40, 50,000. So I know that you're no longer able to expand the relationship past that. So I'm going to benchmark you off that. And then they're saying on the flip side, well, it's taking you 12 months to close $150,000 contracts and you only have like 4 or 5 logos to show for it. How should founders think about that? Like, how do they know what the right approach is when going after the Series A? Should they be talking with investors like you before to say, hey, what do you want to see? Or just like trial and error?
It's a good question. I think a lot of this is honestly trial and error. I think it can be good to kind of get some insight from investors that maybe play at the next stage to get a sense for what they're looking for. But really, that question is kind of a fundamental question you should be asking yourselves as a company: is like, what kind of company are we building here? I mean, is this going to be like, where's the market opportunity? Is this an SMB to maybe mid market play? Is this more of an enterprise scale product in terms of where the bulk of the market is? And how are we going to get there? You may not get there day one, right? You may not be selling to Fortune 500 companies on day one. You may want to prove out, your product and value prop on a smaller set of customers that can be more nimble, work with you. Some people call them facepalm customers that you can fail with, and that's okay. And then maybe you prove out, but you have to have a path toward getting to that enterprise caliber. Is that ultimately where you're going, or is it more? Is the really the best market is like, there's too many competitors at enterprise and they're all entrenched and it's going to take forever to rip and replace those kind of products. So we're going to focus more on mid market or SMB where there's a nearer term pain, and we actually think with our marketing strategy we have an ability to get to those customers very efficiently, and so we can have fast sales cycles. Boom, 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 close deals, land and expand. And that could be a great story too. There isn't really one answer. Like we have to sell the big fancy logos to build a big business. I mean, if you look, and also if you look at, it could be an evolution. If you look at, companies like New Relic or Atlassian or kind of others that have really done a lot to bring front this whole product led growth, phenomenon where it's about growing, starting small and kind of growing up within the organization of the customers they're selling to. It can be great to start with small to mid-sized businesses and really just have a extremely fast sales cycle. Maybe you grow organically through the bottom. So if you're selling like a developer tool product, you get user bases onboarded to your product either through a freemium or open source model. You show value, and then you start to sell up the ranks into the VPs and the C levels of the company, who then see the power of your product in their company before they even before they give you meaningful dollars. That can be a great model, and you just need to have kind of a thesis of what you're building for the long term and what you want to prove out in those early days. And then investors will get that. They've seen successful companies go from kind of those early customers that aren't necessarily representative of the overall market, or if you have a great way to just land quickly and have an expansion model, that can be a really exciting model for an investor. So.
Yeah, I mean, it's definitely exciting for us at Ripple. We tend to gravitate more to the product-led growth and the land and expand models. One, because the size of financing for those companies is tend to be much smaller in order to get to the next stage. And I think if you're going to go after those larger enterprises, you need to have a decent amount of runway to be able to, buy yourself some time to close those big whales. And the other thing is I've seen Series A investors kind of discount the concentration of customers a little bit too much. If they only have a handful of 150,000, 5 customers, pilots and stuff, they don't give them the same value of like 25 to maybe 50 land and expand customers that have gone from like 10,000 to 35,000 in only like 12 to 18 months. So we tend to gravitate more to the product-led growth, land and expand model, but everyone's a little bit different. But I agree, you should be talking with the next round investors to see what kind of flavor they're looking for, right?
Yeah, I mean, I think having that conviction in what the right model is for your business is something those investors are going to be looking for. So just to caveat it with that, and I think sometimes it can be easy to get caught up in like what is this kind of growth stage investor looking for versus like what is the right thing to do for our business. And I would really encourage founders to think deeply about the company they want to build and what's the right model for their customers. Their customers matter a lot more than the investors, and I think if you build a great product, sell it the right way to your customers, and work within the bounds of how they want to buy your product, that's going to attract great investors down the road. So I would really stay laser focused on what's the right model for your business. It's going to look different across different companies, and sometimes investors and VCs can be siloed in their thinking based on their own past experiences and success, and that's not necessarily the right model for your own company. So, I would encourage folks to be creative and think for themselves on these things, but really just follow what the customer wants.
No, that's absolutely true. And yeah, your investors are there for like the financing rounds, but your customers are the ones who touch your product every day. So they probably have a better insight.
It's a lot cheaper cost of capital revenue is than venture capital.
Absolutely. But let's talk about some of the different kinds of firms and investors in the market these days. How are they now playing at both the seed and series A? We talked about it a little bit in the beginning, but I'd like to see, what you have to say about how it is affecting the fundraising processes and what this means for founders these days in terms of the velocity.
Yeah, I mean, financings are happening a lot faster, I think, than they used to, and that's no secret of what's going on. If you just open up your Fortune data sheet or your Strictly VC, you'll see how many deals are happening every single day, and we're seeing it just how quickly these processes can go, especially when it's again great team, great market, and great metrics. It's those financings are happening, before they were planning to raise, and they're happening very very quickly. So I think there's in terms of like what that means for founders, I would say one thing to always keep in mind, when you're talking to any investor is that, they're going to be a meaningful part of your cap table going forward. So, think long and hard about who you partner with, especially at the early stage, right? Where that investor is probably going to own a significant chunk of your business, and they're going to be involved with you for a very long time. It could be a decade plus relationship. And they're preferred holders in the company, and there's all kinds of rights that come along with that. Many times they might be joining your board if they're a lead investor at the Series A, for example. So it is a really important relationship. So, I totally, get and understand the value of moving fast, right? Because these, building a startup, you got to move quickly. You got to have capital. You got to have resource at your fingertips to build the kind of business you want to build on a short timeline. And things do move fast, so it's important. You don't want someone who's going to drag their feet and not have conviction with you on your journey, but also make sure you've kind of properly spent enough time with them and have referenced them accordingly to be strongly supportive of bringing them onto your board or onto your cap table in a meaningful way. But yeah, things are moving faster. I mean, and it's, I think net it can be a very good thing for founders. And I think it does kind of separate the wheat from the chaff on the folks that are highly convicted in your business, in your market. You don't want, like I said, you don't want folks dragging their feet and trying to search for conviction or try to follow somebody else. You want them to really join you on the journey and be all in. But also, there's a lot of different flavors of people out there and investors out there that can be either super helpful, super valuable, or super distracting, to your company. And it's something that you really want to consider as a founder.
Yeah, I mean, buyer beware. If this is a 10-year marriage, just make sure you know who you're getting into and get some, good references from other founders out there is what we say. But, tell us about the kind of flavor of Crosslink. We've co-invested together and we love working with you guys, but, how are you guys approaching this market and competition for deals these days? And how are your funds performing? And, what are your LPs saying? Are they asking you to deploy capital faster? What's going on your side?
Yeah, so Crosslink, our firm, just for those that don't know, our firm's been around for a long time. We actually trace our roots back originally to 1989. We're now investing out of our ninth venture fund. We've gone through a full generational transition of our firm. And Fund Nine is a $350 million fund, which we're investing out of now. And our LPs are very long-standing LPs. We've been lucky enough to have investors stick with us for a very long time, and are great, very long-term kind of partners. So they are very much looking at, can we generate outsized returns over the long haul, and that's an aligned strategy with how we think about the world. We get involved early, so typically, it can be the first or second round, typically, of the business. And I guess in today's speak, that's it's pre-seed, seed, or Series A, depending on the round. So we get involved early, but we're very long-term focused, and we've always been that way. And we're not typically the investor to invest in your seed round and then kind of roll off at the Series A or the Series B. We tend to stick with our companies all the way through exit, and then in some cases, we're still a trusted advisor as a public company, which has been the case in a few examples. So we're very long. That's how we're thinking. We're thinking, any relationship. We view this as a 10-year plus relationship if things go well, and we want to be doubling and tripling down into your business over time, and we reserve a lot of capital in order to do that. And how we're thinking about this market, I mean, we're kind of doing what we've always done, which is invest early, right? And so it used to be seed and Series A, now it's pre-seed, seed, and Series A, but it's really the same strategy. We're looking for the same things, right? And is this a tremendous team that we think can build a category defining, product in a market that we think can be a multi-billion-dollar market and company over the long haul. And if we get involved right off the ground floor when the founder's starting the business, that's great. If we didn't get the chance to invest at the seed round and there's a fit at the Series A, that works as well for us. But we're looking for the same thing regardless, and we're not going to we're not going to change up our thinking based on external factors. Like, it's really about finding those great teams in those big market opportunities. And we do work as a team, so we're very collaborative in our process. And so we want to meet, we want to spend enough time, with the founders. We want the founders to spend enough time with our team to feel like there's great alignment. So as long as that alignment process takes is how long it's going to take. But, we can move quickly when we see a team we like and it's in a market where, we have a thesis in particularly, we can move extremely quickly. And we've done that for years and years. And I think this is just going to continue as we go forward.
Yeah, absolutely. And do you want to share a bit more about your Alpha program so founders can see some of the value add that you bring to the table?
One of the things that's unique about us is our Alpha network that we run. We started this network about 15 years ago. It was founded by one of our partners, Eric Chin. It's a network of it's a founder focused network that kind of for founders by founders. The way it's set up is there's 2,000 members. It's constantly refreshed every single year. We do 60 events per year, so it's super, high high volume of events, but each event is super intimate, and every single person at that event is curated and asked to be there. So you become a member of Alpha by being invited to an event. It's kind of an invite only experience, and you can't buy your way in to the network. And we do that by design because we're not thinking about, can we throw this big conference and make a big splashy thing that really people aren't getting a lot of value out of. We want to talk about real tangible topics of company building. How do you set up a customer success organization to win and improve that net dollar retention? What's going on in the state of kind of the modern data stack? So it could be a sector driven event, or functional company building topic, and then we get 15 to 25 mostly founders around the table trading notes with each other. That are the folks that are in the trenches actually trading notes with each other. We try to foster that community. And so where that's beneficial is, for our portfolio companies, they get plugged right into this network. Not only can they go to the events, but every single person that is, been to these events is in the network from there and then on. And we can kind of pull in these people as resources to our portfolio companies, whether it be as a customer, a partner, or maybe an executive hire or an advisor, or even downstream investor into our company. So we view as investors, a lot of the value we bring is our networks. And so we really formalized the building out of that network through the Alpha network. And we have advisory boards all across the US and Canada that are there to continue to replenish that network. And I know you, Matt, at Ripple, have been a great partner with us on those events. So
Yeah, I've loved going to those events. I miss them. I look forward to doing more of them in person, but I can definitely say firsthand that they add a ton of value. The network is real, and the founders they bring around the table can add a lot of value. So again, I look forward to taking part in them again when things open up again. But before we wrap things up, we always like to ask our guests for their fast favorites. I list off 6 topics. You list your favorite of each one. So first one is your favorite podcast.
I'm going to go with Tank Talks.
Get out of here. Give me another one.
Well, actually, I love Acquired, which is, I'll throw a shout out to my buddy Ben Gilbert over at PSL, who is one of the hosts on Acquired. How I Built This is still great. I just love to hear the founder stories. So, I'm a new fan of Tank Talks. So throw that in there too.
Thank you. All right. Favorite newsletter or blog?
Oh man, there's a lot. I actually have been digging what's hot in enterprise IT, which is Ed Sim over at Bold Start. Should check that one out. It's right in my wheelhouse, and Ed's a great guy and has really wise thoughts in that newsletter.
Nice. Favorite tech gadget?
I'm honestly just gonna have to be lame and say the AirPods. They were the most recent kind of life-changing gadget for me.
Yeah, it's like I said, they're like 70-80% of the votes here.
Oh God, I knew it was lame.
It's all right. Favorite new trend?
I'm going to say the rise of X ops, which is data ops, rev ops, sales ops, customer ops, you name it, ops. I think there's a lot of interesting companies that are going to be built around this trend.
Oh, I like that one. First time I've heard that. All right. Favorite book?
I think I've gotten the most value out of The Hard Thing About Hard Things by Ben Horowitz.
Yep, it's a favorite. And last but not least, your favorite life lesson?
The only thing that's stable is change. And I think that's not exactly what the quote is, but it's my favorite quote and favorite life lesson. I think that's part of the reason why I love venture capital is it's all about change and innovation. The only thing that stays constant is change.
Yeah, I always said if you want to be a good venture capitalist, you better have ADHD because it's never the same every day. So that's what I would say. And thanks for joining us in the tank today, Phil, to discuss what does Series A even mean anymore and what are the metrics that matter with Phil Boyer, partner at Crosslink Capital.
Thanks, Matt.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,